this is really kind of becoming a stock picker's market at the moment, because despite this market not going anywhere, we've had some stocks do really great. Other stocks are kind of just not doing a whole lot. And so it's really been a question in the markets lately about the haves and the have-nots. And there's a very few haves and mostly are have-nots. But again, we've got a big consolidation of volume right in this area. So again, a breakout here to the upside will likely start to bring more buyers back into the markets. But right now, there's we're not overbought. We're triggering a buy signal. The setup here for the bulls is actually pretty favorable going into next week.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, back here at the end of yet another week to give a weekly market recap with my good friend, the machunital Lance Roberts. Lance, how you doing?
That's 2 weeks in a row. There's another word I don't know. Go ahead, tell me.
Yeah, well, so I hope I pronounced this one correctly.
Wait, you're using words you're not even sure you're pronouncing correctly.
Well, because
not fair.
this one was brought to me by a reader actually, and it's a clarification of last week's word. Okay. Where I even have to remember what the word was. It was crepuscular, I think.
Yes, I believe that was it. Yeah.
Yeah, or crepuscular, but basically it was active at dawn or at dusk, because you are very busy in the mornings preparing everybody with your before the bell videos, and you said, well, the morning part's right, but the dusk part isn't right. That's right, when you're basically winding down to get to bed with the sunset. So matutinal, that refers to of or occurring in the morning. So I think it is actually the more appropriate descriptor for you. All right.
I'm still trying to find the word that goes along with vampirism, where I'm just working all night. So,
well, it sounds like that's the opposite of you. It sounds like
exactly.
you are a diurnal creature, if we'll put it that way.
Yeah.
All right. So lots to talk about this week. Why don't we just start with the Fed? I've already had a couple discussions on this channel about it, but love to get your take. Markets kind of didn't know what to do initially with that information. They're up now, but I think it's probably more due to Apple. But what would you take away from this week's Fed's policy update?
Well, it was pretty much in line with what we expect. We had been talking about this for a couple of weeks, is that the Fed wasn't going to hike rates. They weren't going to cut rates either. I mean, basically, there was going to be no change to rates at this particular meeting. Importantly, this isn't one of the quarterly meetings. So on the quarterly meeting, that's when they release the kind of their view of the market going forward, right? So that's where they give you their PCE, their GDP, and inflation numbers for, employment numbers, what they expect, over the rest of this year, next year, and the year after. So this wasn't one of those meetings. So again, there was really no expectation of any change there. Kind of what we said on the radio show is that if the Fed, though, comes out and says something dovish, that would certainly buoy very well for the market. And the Fed certainly did that by coming out and say, hey, we're going to, not only are we going to reduce QT starting this summer, we're going to do it by more than expected. And that sent the markets up. We were down about 30 basis points prior to the meeting. When Jerome Powell discussed the QT part of his speech, markets ran up a full point. And then we had a sell program right at the end of the day kick in, which was not really unusual. There's a lot of trap longs in this market from this recent sell-off. So rallies to resistance should be expected to be sold for right now. That's very bullish and healthy, by the way. So, and we can, when we get to the chart here in a second, we're building a very nice bullish pattern in the stock market right now. So, and then of course, after the market kind of digested that information overnight, Thursday and Friday, we had very nice days in the market. So, again, this is kind of all just, and yes, part of the rally today is certainly due to Apple. And we'll talk about that one in a minute. Because you got to love Apple and you got to love Google. So if you don't own those, you're completely missing out right now, because they're going to be driving the markets for a long time. For one reason, and we'll get into that one reason here in a second. But overall, the other takeaway is when Jerome Powell was questioned about stagflation, he says, I don't see stag and I don't see inflation. And he's absolutely right about that. In fact, that's the core of this weekend's newsletter that we're going over, is the myth or fact of stagflation. And if you want, we can spend a few minutes in a minute kind of going through some of the charts. But we've never had stagflation in the US. A lot of people go back and talk about the 70s. We never had stagflation in the 70s either, because the exact definition of stagflation is high inflation, high unemployment, and low GDP growth. Well, we've got strong GDP growth right now. We've got low unemployment, and inflation's at 3%, which is about the average historical inflation rate. Historically, it's a little bit above, but not a lot. Average historical inflation is about 2.3 to 2.5. So we're a little bit above that, but nowhere near high rates of inflation. Now, again, this is, as we said before, you got to be careful when you talk about inflation, because immediately what everybody says is, well, have you been to the store lately? And yes, I've been to the store and it's expensive. But that's not how we measure inflation. How we measure inflation is I go to the store today and I buy eggs for $4 a carton, or whatever it is where you live, and that's expensive. If a year from now those eggs are still $4 a carton, inflation is now zero. So it's all about the year-over-year price change in inflation, and that is slowing down. So we don't have any of the ingredients right now for stagflation. That's exactly what Jerome Powell was saying. He says, I don't see stag, I don't see inflation, because inflation is coming down, and it will continue to come down, particularly as homeowners equivalent rent kicks in over the next few months.
All right, let me just ask on that, and I know what Powell said about this, but you said strong GDP, which has been the story, but we did just get a 1.6% GDP growth in Q1. So somebody would say, well, that's not strong economic growth.
Well, actually it is. Over the really ever since the turn of the century. So anyway, let's go back to 1947. If you go back to 1947 and look at the trend of real GDP growth, from 1947 to 2008, we were growing at about, through 2000, my apologies, through 2000, we were growing at about 2.8% real GDP growth. Following the dot-com crisis, that rate dropped to about 2.5%. Post the financial crisis, we were at 2.2%. And have been growing on a real GDP basis around 2 to 2.2% really for the last 14, 15 years. So that's more of a normal growth rate now for the economy based on debt, population, density, those type of things. So, what we're coming, and remember also too, when we talk about 1.6%, that was one quarter's number. We just coming off 4.9, 3.3, 1.6. So GDP is slowing down. And you and I have talked about this, is that economic growth will slow as all that monetary stimulus that we put into the economy post the COVID crisis, continues to evaporate out of the system, right? So that python still, that pig still moving through the python. So economic growth is going to slow back towards that 2% target. And I would postulate that over the next decade, that we're likely to see real GDP growth coming in somewhere around 1.8%, 1.7% on an annualized basis, simply because of the debt and because of the dispersion of, I shouldn't say dispersion, but because of the diversion is the word I was looking for, of disposable real incomes being sent to service debt, interest payments, versus productive investment. And so that's going to lead to slower economic growth as we go. So yes, economic growth is going to slow down. We're going to get more normalized on that. And with that, inflation and interest rates will also decline.
Okay. All right. So we had, it's kind of been an interesting couple of days, because we had the Fed guidance put out there, and then Powell's press conference. Then we had Apple, surprise to the upside with their earnings call. And I want you to talk about that, because it really is largely all due to one thing. You look at their revenue growth, it's still pretty dismal, right?
They haven't grown revenue in 6 years, so.
Yeah. So it's other, levers they're pulling, which I want to get into. But then on the day we're speaking here on Friday, the payroll data came out, and it surprised to the downside, right? Which, in the crazy world that we live in, markets cheer because they think, okay, that gives the Fed a little bit of a reason to cut. And we did see rate hike expectations for September. I think they jumped by like 45% or something like that, right after that report came out. And I did notice during Powell's press conference, all the journalists kept peppering him with, well, so are you going to cut? Are you going to hike? And he was really trying to bob and weave and not get pinned down. But when they asked him, what are the things that would cause you to cut? He said, well, obviously, if we see signs that inflation is making the progress we want to see down to our 2% target, we will. And that's not the case right now. And he kept saying, it's probably going to take longer than we all want. But then he would say, or if we see real perceived weakness in the labor market. And he mentioned that he mentioned it enough where I was like, is he worried about perceived weakness in the labor market? And maybe he saw some advanced data on what this print was going to be. I don't know, but this is
absolutely, he knew what the employment number was going into that meeting. No doubt about it. Yeah. Right. And honestly, he probably knows the inflation number already, which we'll get. And I think next week, I think we get the inflation report. I'm sure he knew that number already. But yeah, I mean, look, again, we got to keep this a little bit in context too. Yes, the number was weaker than expectations, but we've been running at 280, 300 1,000 jobs a month. That's well above the long-term average. On average, the U.S. creates about 150 to 180,000 jobs a month. So it's a weaker employment report, but it's still 170,000 jobs in a month. Now, there's a lot of context that goes into that 170,000 as to where those jobs are made up. And, we've talked about foreign-born versus native-born workers, et cetera. One of the big adjustments that were in this number, which if you strike that out, would really imply a much weaker employment number. And this has been the case for a while, by the way, is that birth-death adjustment, which is supposedly the number of new businesses we're creating versus the ones that are shutting down. And there's a vast difference between that number, because every month, pretty much the BLS says, oh, we created 200,000 new businesses, right? So if we create a new business, that's supposedly a new employee. Well, reality doesn't work that way. But this month, there were I believe, don't quote me on the number, but I think around 353,000 new businesses, right? So new births, which added to the employment number and brought that up. On the household survey, we only created like 25,000 jobs. So in theory, if we look at the household survey, that employment number was drastically weaker than what headlines say.
Yeah, actually,
but again, markets don't care about that. Markets care about BLS data, right? So
yeah, and all they care about is just, hey, we smell higher probability of rate cuts, so let's party.
Correct.
But yeah, just a couple other clarifying comments here. One, the new data increased the unemployment rate from 3.8% to 3.9%. That wasn't expected. It was expected it was going to remain flat. Yep. The household, there's two surveys that the BLS does, as we've talked about in the past. The establishment survey is the one that has all the, adjustments and the fudge factors and stuff in there. Yeah. The household survey, they're calling up and talking to real people. There's issues with the household survey too, but those have been very different, as we've talked a lot about in this program. But the household survey was really strong in March. It was almost 500,000 jobs in March, but it just added only 25,000 this time around. So massive drop from that. Couple other things.
And that household survey is very volatile, by the way. And that's part of the reason they don't use the household survey, because that thing jumps around a lot. But again, it is what it is.
Right. But just directionally, right? It's just like, okay, wow, that's really different. Some other jobs data too that I pulled. One, we're still seeing like really flat claims data, right? Mm-hmm. And we've talked a lot about how some of these job numbers really just seem really hard to wrap your brain around. Dave Bianco's done a really good job of late showing how the claims data, I think the initial claims data, like 5 out of the past 6 periods have been the exact same number, right. Which statistically is really kind of defies math. But a couple of things. So one, Bloomberg came out with a piece this week that sort of explained why claims are a flawed indicator. I just want to mention these. One, it says that the surveys they use for it don't pick up undocumented workers, the activity in undocumented workers. So if they're getting laid off, they're not getting, that data is not getting into the system here. Also, there are penalties for taking unemployment that increasingly people are saying, look, I'm actually better off if I go get a part-time gig job, right? If I do some Uber Eats driving, I actually will make more money than if I just collect an unemployment check.
Right.
And what was interesting is I didn't know this, but like the deal can be pretty bad. So like in California, apparently California hasn't raised their unemployment benefits in 20 years, right?
Raising minimum wage left and right.
Yeah, yeah, but I mean, I guess in this state, it's just it's a you know, on a relative basis, it is more and more compelling to say, or at least I'll do something because I'm actually going to get more than what I'd get if I just, you know, had to do all the work to go get my unemployment check.
Well,
So
but that's interestingly you say that is it's interesting, but assuming that you can get a job, right? And we're hearing more and more people talking about being able to get a job. Like there's tons of job openings, but nobody's actually hiring. So
right.
putting out all kinds of resumes, and they're doing door knocking, whatever, and nobody's hiring. And and this is going to be the interesting thing about California, where you live, with this new $20 hour minimum wage, is how many people lose their jobs or get out to off their wage, which means that if I was going to compare apple to apples, I'm probably better off going to McDonald's and working for $20 an hour than filing for unemployment, to your point, right?
Well,
So
to my point, but it's
who's going to hire me?
well, it's getting hard to get that $20 job at McDonald's, to your point, right?
That's my
And
point.
I just tweeted out this headline the other day saying this was the most predictable headline of 2024, which is basically that not only are the employers cutting staff, cutting hours because of the raise in fast food worker minimum wage to $20 an hour, but they're obviously having to push up prices to support those cost increases. And now the buyers are going on boycott. They're like, it just costs way too much to eat at McDonald's or Chipotle or whatever. And so there's a backlash now. So everybody's losing, right?
Yeah.
So
I read a really good article this past week. A guy buys a double beat chicken bowl at Chipotle when he's in Vegas, and he went to California. He said the same bowl in California, his bowl cost $17 in Vegas, and in California it now costs $35. It's almost twice as much.
yeah, and that's for one guy's bowl, right? You take your
Yeah.
family there, and you're up at over $100 at Chipotle, right?
Yeah. And that was a fascinating thing from McDonald's. Talk about McDonald's this week, is that McDonald's reported much worse than expected earnings. Stock was down fairly sharply, along with Starbucks.
I was going to say Starbucks too. They got crushed.
And Kentucky Fried Chicken. So we're starting to potentially see the impact of higher costs and all this stuff we've talked about week after week after week after week. It's never showed up yet, but maybe we're starting to finally see the consumer cracking and at least making choices. Hey, you know what? I'm not going to go eat at McDonald's as much because it's just too expensive. It's just too expensive to go out to eat. But I thought McDonald's response to their earnings report was fascinating, because they said, yeah, it was a pretty bad quarter, but what we're going to do to fix that is come out with a bigger burger, which means you'll charge more for it, which that's not your problem. The problem isn't the size of the burger, it's the cost of the burger yourself. So
right, it's like truck sales are bad, so we'll just make bigger SUVs. But so we are beginning to see all those indicators, and I don't have it on my list this week. I had it last week. We didn't get to it, but we're also seeing the same thing at the luxury end of the market. Like, the brands like Gucci and all these traditionally high-end products, they're really suffering too now. So Lance, it's almost like there's some sort of lag effect going on in the economy, right?
Maybe the lag effect is going to finally show up. Adam, you're going to be right someday.
One of these days.
See, Adam, you're going to be right with a lag. So
that's right. I'll be right, just with a lag. So two more quick things just to put the final nails on this thing. One is that the quit rate is down to pre-pandemic levels at this point in time. And so I think that's a really, sort of truer indicator of what's going on, just in terms of where the power is lying between the employer and the employee. Right. And I think at this point, we can now say that the Great Resignation is over, right? That
you can't job hop now for a better salary.
You can't job hop for a better salary, and you can't threaten your employer, hey, you know what? If you don't give me a raise, I'm out of here, right? Because the employer now has more options.
Yeah, go ahead. We were thinking about firing you anyway, so just save for trouble.
Yeah, exactly. Hey, thanks. There's the door, by the way. And then also new hires. Those have come down not only to pre-pandemic levels, but they're actually now down to where they were in 2018. So no big surprise, and we've been, like you said, tracking this. But companies have basically said, look, I mean, obviously they're starting to lay people off more. We've had a huge burst in layoffs since 2024, and we see all the WARN notices and all that stuff. We're still not seeing it yet in the claims data, but we're definitely seeing this as something you would expect when companies are getting more conservative, is they just stop hiring people.
Yeah. Well, and again, if you remember, you and I have had a couple of conversations about the NFIB report with the National Federation of Independent Business, and they've been predicting, their data has been saying this is going to be coming for a while. They've been cutting back on hiring, cutting back on raising compensation. So now we're starting to see it. And again, that's usually the case. They tend to lead a bit of the overall economy because small businesses are so very important. But that data has been telling us for a while this is coming. And so now, it's starting to show up.
Okay. All right. So it'll be interesting to see. I think you and I look at data like that, and we probably have concerns about, where the economy may go. But not the markets. Right now, the markets are saying that's good news, and that's going to get us our rate cuts.
And that's okay. And that's immediately people kind of jumps like, it's stupid. The markets are going up and all this data is so bad. It's okay, though. It's okay that the markets are doing one thing and then the economic data is doing another thing. It's okay. There's nothing wrong with that. Markets are based on earnings growth primarily, and earnings are growing, right? Now, most of that earnings growth is in the top 10 stocks, but earnings are still growing. So if you look at earnings on a year-over-year basis, those are rising, they're positive. So that helps support growth. It certainly doesn't jive with some of the more dire economic data out there that certainly suggests the economy is slowing down. But that's okay. That can last a lot longer than you think. So it's always important to kind of keep buckets. This is the economic data, this is the financial data, and those two don't always agree with each other.
Yeah. All right. Well, so let's get to the charts, but real quick before we do, let's talk about what is driving the action in Apple stock, and it's similar to what we saw with Google last week.
So I've actually been writing some articles, over the last couple of years, talking about stock buybacks. And stock buybacks have been a very critically important part of the overall market, and particularly the driver of the market since 2009. In fact, since the turn of the century, let's see if I have this chart handy real quick. Yeah, so since the turn of the century, net corporate buying has made up absolutely 100% of net purchases. So once you back out both the domestic purchases of stocks, back out foreign investor purchases of stocks, back out mutual funds, hedge funds, etc., those actually net each other out. So the net purchasing of equities between those four groups is effectively zero since the turn of the century. 100% of the net equity purchases have come from stock buybacks since 2000. And that's been accelerating over the last, really since the financial crisis, because actual economic growth has not supported the rate of earnings growth. In fact, if we take a look at revenue growth and EPS growth relative to economic growth, sales growth, what happens at the top line of the income statement, is very, very weak relative to the growth in the economy. So we've had weak economic growth, been running about 2%. Sales growth has been running about 2% on a cumulative basis. All the growth in earnings has come from either accounting machinations, which accounts for a big chunk of it, and stock buybacks, which lowers the number of shares outstanding. So when you look at EPS, earnings per share, those buybacks lift the value of the EPS number. Doesn't improve the top line revenue. Doesn't mean I'm selling more product. It just makes it look like I'm making more earnings because I've lowered the number of shares outstanding. And this year, before earnings season, we posted this chart. We said, here's the reason the correction is probably over that started back in March. And two reasons for that. One is earnings growth is continuing to be fairly robust. and stock buybacks are about to open back up. So starting next Monday, actually starting Monday, not next Monday, but this coming Monday, the buyback blackout window will reopen. And so all of a sudden, these corporations start buying back their shares again. This year is slated to have over $1 trillion worth of share buybacks. Apple and Google will comprise almost 20% of that entire amount.
Oh my gosh. Two stocks, huh?
Two companies. They'll buy back there. So Google just announced a $70 billion increase in their buybacks. And Apple, despite a 4% drop in revenue, announced a $110 billion share buyback. So between those two, you got 200 billion out of $1 trillion. So it's almost 20%.
So let me see if you can help me understand this. I saw a tweet last night from Adam Kobiesi at the Kobiesi letter.
Yeah.
And
I'm sorry. Real quick, while you're talking,
yeah.
this was the chart I was looking for, just so everybody can see it. But that's net equity purchases versus corporates. Go ahead, keep going.
Okay. So it said that Apple just announced that they're doing what was it, 110 billion?
Yeah. 110 billion.
And the stock jumped by, I think, 180 billion in market cap. So how do you get that?
Well, so here, so look, at the end of the day, and this is what I was talking about, that when we take a look at, here's the chart I was talking about. At the end of the day, what matters to the market is whether earnings are increasing or declining. So you can have whatever narrative you want, right? Economic recession, economic boom. You can have, end of the world versus the absolute nirvana. Whatever narrative you want doesn't really matter, right? That's what I was saying earlier. You got to kind of keep things in two different buckets. What matters to markets is earnings per share growth. So this is trailing earnings per share going back to 1999. So this is just over the last 20 years. But during periods where EPS is growing on an annualized basis, stock prices rise. Voila, right? I mean, it's not really surprising because as earnings are increasing, investors are buying stocks in anticipation those earnings will continue to grow. When earnings are declining, that's when you get into more troubled markets. Not necessarily a bear market, but you get slower rates of return, more volatility, you get downturns in the market, et cetera. As a good example, when we were having the Euro crisis back in 2015 and early 2016, this was Brexit and all that, earnings were negative. Earnings growth was negative, and the market went through 20% corrections during that period. And then Janet Yellen gets on the phone with the Bank of England and says, hey, y'all need to start doing QE and ECB. And they started doing QE, and then we got the next run up, in markets and earnings. So again, what's important right now for the narrative and why you want to be long stocks versus other assets is because earnings are growing. And how are earnings growing? Well, they're growing by stock buybacks. If I keep cutting $1 trillion a year off the number of share count, I'm going to grow earnings. It's just a function of math. Right?
Okay. Yes. The earnings per share growth is just a function of math. And we've talked about this a lot in the past. But in theory, accounting wise, it should be a wash. There was no value creation there per se. But clearly the market believes there is.
Well, there is no value creation, right? So, so let's do a real simple mathematical experiment to kind of explain this, right? So you and I have a company and we have one share outstanding, right? Or sorry, two shares outstanding, right? Mm-hmm. So, and we earn $1 in revenue, right? So this year we have $1 in revenue. Our earnings per share is 50 cents per share, right? That's easy. That's easy math. So next year, you and I coin together 50 cents a piece or 25 cents a piece, we buy back one share, right? So we earn $1 the next year, but we only have one share outstanding. Now our EPS is $1 per share. Now, we didn't create any more revenue. And this is the problem that's going on with companies right now. We're not growing revenue. But what we're doing is reducing the outstanding share count, which is making the earnings per share. So what happens at the top line and what happens at the bottom line of the balance sheet or the income statement are two very different things. We're not creating a tremendous amount of revenue growth. Apple's a great example of this, right? 4% drop in revenue growth. But EPS is doing okay because we're reducing the number of outstanding shares. And so this is why there's such a a bias towards for big companies to do share buybacks because it helps them meet Wall Street estimates. They can and if it lifts the asset price of the stock, then executives can cash in their shares. And because that's what buybacks benefit. They've got the people that actually sell their shares back to the company are insiders. They're not you and I, right? You and I can sell our shares of Apple any day of the week on the open market. But if I'm an insider of the company, one of my only options to liquidate compensation plans is back to the company itself. So share buybacks benefit the insiders, and that's keeping everybody happy.
So just to make sure people really get the story, with your example there, right, where we retired one of our 2 shares and our earnings per share doubled, right? You said, yeah, but revenues were flat, right? So top line was flat, but earnings per share doubled. I just want to make sure folks understand in your simple example there, earnings were flat. So the bottom line of the company didn't change. It's just earnings per share that changed. So again, it's really just an accounting thing, but you know,
and you said it right. We're not creating any value. You know, and that's really kind of the underlying problem. I've actually got a chart on this. Give me 1 second here. This is some analysis I did a while back. I haven't updated this recently, but I think it's a little bit dated. This goes through 2021, so it's a little bit dated. So just bear. I'll update this in a article soon, but you'll get the general idea of what's going on. So on the left is reported earnings. So again, you know, what matters at the end of the day is what we actually made, right? Pro forma earnings are earnings without any of the bad stuff, right? So we just those are fantasy numbers. You should never look at operating numbers for anything. Reported earnings is what we actually made, right? That's what was actually earned. So if you take a look at the blue line, that's shares outstanding. Now, again, there was a little uptick during 2020. We had IPOs and stuff going out like crazy, so that's why you kind of see that uptick in shares outstanding. Since then, that's tailored off rather sharply with all the buybacks. So again, a little bit dated here. Just bear with me. But I want you to notice this little graph at the top. It says operating EPS versus sales per share. So remember, operating is perfection. If everything is great, how much money am I going to make? So since 2000, operating EPS grew by 387%. But sales per share, what happens at the top line, right? So to go back to our example about that dollar that we sold, that only grew 73% cumulative during that same period. So how do you take a dollar and multiply it 4 times, right? To get down to operating EPS. There should be at least a somewhat close correlation between your sales and your EPS, but that's not what's happening. And that's solely because of this massive decline in shares outstanding, which is giving you this very big boost to the reported EPS differential.
Okay.
And the chart on the right shows you the difference between revenue growth and accounting gimmicks, including buybacks.
Yeah. So I assume that if we overlaid a chart on here of stock valuation multiples, that we would see that increasing over the same data set as a result. Is that?
And you also, right? if you overlay a chart, it almost identically matches the reported earnings differential. Okay.
All right. So the underlying point just there being is we are more richly valuing companies' earnings as a result of this buyback campaign.
Absolutely. But again, so we'll talk about trades later, but I just sold a position in CVS today.
Which you used to love.
I still do love the company, and I think long term it's going to be a winner. But I am literally giving up on the company because it's probably a good time to go buy it because I'm giving up on it. Generally, that's the way it works. But this has been a company that's just had one bad thing happen to them after another. I mean, between Medicare and Medicaid and law changes and you name it, it's just been hit over and over and over again. So going into earnings, we bought a position in it that, you got a stock that trades at 0.2 times price to sales, a 7 PE with almost a 4% dividend yield. I mean, fundamentally, it's a great company, right? They grow earnings. Every time you get sick, you go to a CVS. I mean, I can make you the whole fundamental case, but this is a great point about what's going on in the markets. Fundamentals don't matter. This is a great, fundamentally strong company something you should want to own. But they came out and announced earnings yesterday, slashed their guidance because of what's going on with Medicare, Medicaid. Stock was down 20%. I'm done with it. So, well, I'll tell you what we swapped into later. But
you know what they need?
But
CVS just needs its own AI chatbot, and then it's
yeah,
off
absolutely. Just get into the data center business with AI healthcare, and the company will be golden. And like I said, it's good. Look, and at some point, probably next year, once we get through the election, I'll probably buy it. I'll probably take another stab at it. But for right now, I'm just going to let it try to figure itself out. But again, what my point about this is that fundamentals really don't matter. I mean, honestly, if you take a look here, let's take a look at our portfolio here real quick. We don't do this very often, but I'll do it with you here real quick. So let's just take a look at the portfolio. We don't do this very often, on this channel, but I think this is a great conversation to have, kind of right now, because this is a very different market, and again, we kind of go back to these narratives of the world, right? So you remember last year, you and I were talking, it was the death of the dollar. The dollar was going to die and everybody was death of the dollar. We were writing articles why that wasn't going to be the case and warn people about that narrative. Now the dollar's been rallying like crazy, right? So you got to be careful with narratives. We talked about that before. And, this is the problem in this market. I'm a fundamental investor. I like buying companies that have good, strong balance sheets or fundamentally strong, growing their earnings, those type of things. But you can't invest that way right now because this is just not the market for it. So if we take a look at the portfolio, I mean, we get down to looking at companies like, Apple. We own Apple, we own Google, we own, AMD, we own NVIDIA, right? There's just a plethora of companies that really, you go, those stocks are so overvalued. Why would you buy those stocks? And fundamentally, I can't make an argument for why you would buy those. I have to make the argument of my job is to make money for my clients. And so I've got to have stocks in the portfolio that are driving the market. So, we own those companies, and, we'll continue to own them. But we do have some fundamental plays in there. We love Stanley Black & Decker. They had a really good report yesterday. Stock got hit because of their report, but there was actually nothing wrong with their report. So we actually bought some more Stanley Black & Decker today. And that's a position we've been building for about the past 4 or 5 months, and so it's a fairly new position to the portfolio, along with Genuine Auto Parts. We just added that one, I think, last week. So it's a very young position as well, and very small right now. We're just starting to feed into that one. But our thesis on both Stanley Black & Decker and Genuine Auto Parts, which are both fundamental companies, right? Now these are fundamentally strong companies, so we're buying them on those fundamental bases. But our thesis is that if the economy slows down, you have people doing more of their own auto care, their own DIY projects around the house. Those companies should benefit. And I think that will be the case. So these are very young positions. But if you look at some of our older positions, Microsoft, Costco, we've owned since we launched. This portfolio was launched in 2019. So we've owned Costco. We've bought and sold these stocks multiple times and when I say bought and sold, we bought them, we built a position, we trimmed them back. When stocks got overvalued, or went through a correction, then we would buy them back again. So we've bought and sold these companies multiple times along the way. ExxonMobil, Eli Lilly, that's a fairly new one. But most of these companies we've owned for a long time. We're going to continue to own them. AbbVie, one of our healthcare stocks, we'll continue to own that forever because my wife supports that company with Botox.
You're a dead man for admitting that publicly.
Oh no, she'll tell you. She goes, she's in her early 50s, and she goes, you know what? I'm not going down gracefully. So she will own up to that in a minute.
All right. Well, look, I'm going to mention one thing that may be brought up later. You wrote a piece, I think that just came out today, about behavioral traits that are killing people's portfolio returns. And if we get a chance, we'll talk about that. If we don't, folks, go to Real Investment Advice and go read that. It's a valuable article, folks. But one part of that is, or I know you mentioned it, you don't mention it, but it made me think of this. And I did a little bit of internet searching before we hopped on here. There's an apocryphal story, and I don't think I've been able to find anybody who's actually found the underlying source data. But apparently the rumor is that Fidelity did a study, and they noticed that from the results from the study basically said their best performing client portfolios, for the people that are using Fidelity as a discount brokerage and managing their own money themselves, DIY, were people who died. And it was
Yeah.
people who they didn't touch their accounts, and their accounts ended up growing the most. And it's because we tend to make a lot of really bad decisions, because a lot of people aren't super educated and how to manage money, but more importantly, we just get whipped around by our emotions, or we're reacting to headlines, or all the things that you warn us about. Now, there have been studies that have shown that people who have forgotten that they had accounts as well, it's sort of similar to being dead, also have superior returns. So take this with a little bit of grain of salt, because nobody can really find the underlying study that's being cited. But the subsequent ones do say that, hey, generally, the less people touch their portfolios, the better they do. Although it said the best combination from the study was people who did annual rebalancing,
Yep.
like you're talking about here. Right. So basically a light touch, but just checking it every once in a while to say, hey, have some positions gotten too high or too low? Let me rebalance, and then not touch it again for a good while. Right.
Okay.
So
Yeah.
just want to underscore, like, basically what you're doing is a lot of the latter. Right. You said we've owned a lot of these companies for a long time. We come in and we harvest and garden, but as long as we don't have some huge fundamental case to get rid of them, we'll let it ride.
A la CBS, right? And sometimes you just gotta cut bait and just go away, and then But look, and there was I got a Twitter comment the other day, and this person listens to your show, and we talk about stuff here on the show, and she's like, well, you talk about stuff that you do all the time, but you never admit your mistakes, and that's not true. I've told you before that we bought Meta back in 2020, kind of at the low, 2022, sorry, at the lows. Meta was trading around $100 a share. We made a fundamental case for it. We bought it right before earnings. Stock opened down 20% the next day, violated our stop.
Yeah.
We got out, and then we missed 500% return, right? Because we didn't get back in. So we made two mistakes, right? We sold it, and technically we sold it right because it violated our stop. So, so that part was right. The problem was we never got back in. And CVS, it's another good example. Look, you're not going to hit every stock right. I mean, there's going to be some things that just don't work, and you've got to say, okay. And that doesn't mean that you bought a bad company either. Sometimes you can buy a great company at the wrong time, and you basically just overpaid for it. Then the stock goes through a big correction, and then it becomes a better buying opportunity. So one of the psychological things I've always found fascinating about people is that they'll buy a good company, and then they get stopped out of it at some point, right? It goes down, and CVS is a good example, right? So right now where I am, I'm mentally done. I'll never touch the company again, right? So that's me mentally at the moment. But I know realistically, if I start to see the stock improving, the fundamentals are still sound, then I'll probably buy it back at some point. But a lot of people put themselves in this position to where, I lost money on that company, I'll never buy it back again. And it doesn't mean it's a bad company, you just bought it too high. And so when it corrects, you'll have a better opportunity to buy that company back again at a better price. But these are all those psychological pitfalls that we kind of fall into, gambler's fallacy, herd mentality, cognitive biases, et cetera, confirmation bias. Those are all part of those psychologies that lead us to making mistakes. And look, I have them, constantly. I battle these things every day, and that's why we write such a diverse set of articles on our website, because we're always analyzing the data, right? We're looking at the bearish side, we're looking at the bullish side, we're trying to make cases for both sides so we can have a better understanding of what our portfolio should do. But fighting that confirmation bias, that's one of the biggest challenge. That and gambler's fallacy is some of the two of the biggest things that people have to conquer.
All right. Well, if we get a chance, we'll go through the takeaways from your recent piece, and maybe you can explain a few of those things for folks that perhaps don't know, like what the gambler's fallacy is. I do want to get in a second to just the S&P chart, so you can show folks where we are technically right now. Real quick, just to your last point there, one of my favorite interviews I've ever done was with Robert Cialdini, who wrote the book Influence back in the 90s, which has really kind of become like the marketer's Bible. And and he's a behavioral economist, and he basically just goes through what he has, I think, the 7 principles of influence, which explain how we as humans, given our evolutionary animal wiring, how we can be manipulated. There are these evolutionary hacks in terms of, or evolutionary shortcuts that we have just based upon how the animal kingdom evolved. The fight or flight response is a good example of that, where 99 times out of 100, that quick shortcut is a net benefit for us, right? But savvy marketers and politicians, whatever, have figured out how to hack these things, and they use them against us. And it's a fascinating book. It's a super fascinating interview, folks. If you want to search my name and Robert Cialdini, I highly recommend it. But he's like, look, I wrote the book, and I fall prey to these things every day. Like I'm just trying to keep my average high, right? My batting average high, being able to see them and spot them. But I know that that I still get, sometimes subconsciously manipulated like this, or I can feel myself responding. And there are times where I know I can see myself getting taken advantage of here. But it's hard because it's just how we as humans are wired. So even the greats have a hard time resisting this stuff.
Oh yeah, and look, it's just because we're human, and it doesn't make us bad investors. It doesn't make us stupid, and nobody wants to, admit that they're wrong, right? That's always the hard part, right? That's always the challenge, right? Is just to admit to ourselves that, hey, we were just wrong, right? So we tend to hold things for a lot longer than we should. And make all those kind of mistakes, but that's just because we're human, right? That's just kind of human nature. And that's the biggest challenge of investing in your own portfolio, managing your own money, is that it's just a challenge to fight those psychological biases, over time. I've told you before about people that have, they've been out of the market since 2008 and they never got back in because they didn't want to go through that 50% loss again. And that's the one thing that they're scared of. It's like, oh my gosh, I don't want to lose 50% of my money, but they gave up almost 500% gain trying to avoid a 50% drawdown.
Yeah. Well, I mean, this is honestly one of the bedrock reasons why I recommend so many, viewers, unless you've got a really good track record of being a successful DIY investor who has built up not just the knowledge of how to invest well, but also the psychological defenses about how to not get taken advantage by our worst natures. This is a huge part of the value that a professional financial advisor provides you, is they take a lot of the emotion and a lot of the irrational thinking that we do because we're humans out of the equation for the average investor, right?
Yep.
Yeah. All right. Well, look, can we pull up the S&P chart for a second? Just give folks a quick sense of where we are.
If you insist, right?
Well, last time we were at a kind of a key juncture, so I'm
we were
on tenterhooks trying to figure out what's coming next.
Yeah, no, we absolutely were at a key juncture here. Let me get over to the chart. Your face is always in my way when I'm trying to do stuff.
Online and offline.
Yeah, there you go. So this is a kind of our chart that we've been kind of watching the last couple of weeks. So there's a couple of things that are going on right now that I think are really, really important. So if you kind of take a look at what the market's been doing here just lately, is that we've got this kind of a wedge pattern that's now building. And so you've got this kind of declining tops during this correction, which is not surprising. But over the last, few weeks, now a couple of weeks, you've actually had these rising bottoms. And this is kind of tracking along that 100-day moving average, which is that orange line. So you've got this compression of prices, and markets tend to act, on, kind of this compression in one direction or the other. So think about kind of compressing a spring. At some point, the market's going to break out of this range, and whatever direction it breaks out of, you're likely going to get a fairly substantial move as that spring kind of decompresses a bit. So, right now the market's been just kind of bouncing off, forming these higher lows. That's a very bullish sentiment. We're just triggering a MACD buy signal as of today, which is also bullish, and we're challenging right now the 50-day moving average. So this is the second test of the 50-day moving average. Now that's important because we expected to fail that first test of the 50-day, which we did. So last week we rallied to it and then sold off and came back down and theoretically kind of retested that 100-day moving average, found support there, and then rallied from there. Now we're retesting that position today on that 50-day moving average. So if next week we can climb above that 50-day moving average, then we're going to break out of this compression. And theoretically, that'll let the market try to challenge at least kind of the recent highs in the market, if not. Now, if the market fails next week, we get some bad CPI data or whatever it is next week, and the market sells off, then we're going to retest this 100-day moving average again. So we're kind of stuck between these two moving averages for right now. So again, this is really kind of becoming a stock picker's market at the moment, because despite this market not going anywhere, we've had some stocks do really great. Other stocks are kind of just not doing a whole lot. And so it's really been a question in the markets lately about the haves and the have-nots. And there's a very few haves and mostly are have-nots. But again, we've got a big consolidation of volume right in this area. So again, a breakout here, the upside will likely start to bring more buyers back into the markets. But right now, there's we're not overbought. We're triggering a buy signal. The setup here for the bulls is actually pretty favorable going into next week.
Okay, and just for what it's worth, I recorded an interview the other day with behavioral economist Peter Atwater, who also does look at markets, and he has said similar to what you just said there, Lance. He said the markets are coiling from his point of view, kind of in that compressed wedge there. And he says, I'm not sure which direction it's going to break, but the indicators he's looking at, he says, suggest it'll be a big move, whichever direction it decides to break.
It is. And, if we break to the downside and we take out that 100-day moving average, which is possible, we're going to retest the 200-day moving average, which is around 4,800 right now. So decent move to the downside if we take out this, recent support.
Okay. And I'm assuming if we were to break out to the upside, you would think that new all-time highs wouldn't be surprising to see?
Well, so if you take a look, so now we're just going to start talking about theory here for a little bit. I mean, yes, it's certainly possible. But in presidential election years, April and May tend to be, actually April tends to be a weaker month and May tends to be a little bit weak. And then June, July, August tend to be fairly bullish, right? And this is because, first of all, you've gone through 2 weak months, April and May, and so you get a little bit of pin-up buying. And then markets kind of tend to move higher in June, July, and August. Then in September and October, we tend to get a fairly decent correction going into the election. And this makes sense because Wall Street really doesn't want to be long equity, not knowing who the president is going to be, right? So you got two very different presidents, that we're voting on this year. So one wants, 44% capital gains tax rate, wants to spend money on everything that moves, increasing debt rather dramatically, et cetera. The other one also wants to increase debt, but he wants to cut taxes and, institute tariffs. And so you've got two very kind of diametrically opposed presidents in terms of policy. So Wall Street doesn't really want to deal with that going into it. So typically we get a sell-off going into the election because of the uncertainty. And then once they know who's elected, you tend to get a rally in November and December because now I know who it is, right? So I know which president, I know what the policies are. This president's going to be big on infrastructure spending. This president's going to cut taxes, whatever it is, and then they can bet accordingly. So, we may see some temporary new highs if we do break out to the upside in the next month or two, but likely not substantially new highs. I think I think we can make the case we've probably seen the highs for this year, or at least close to them. And then we're going to have another correction and then probably another rally in the year that kind of gets us back to about where we are right now or at previous highs. But, I think we kind of finish this year potentially where we are right now.
Okay. All right.
Let me give you one caveat on that. The one caveat is that the Fed goes back to QE and does 4 rate cuts this year. So all bets are off at that point. So
well, all bets are off on that point too, because I have a hard time seeing them do that unless, there's a real emergency in the system that's requiring that. or, to use Pal's word, like there's either going to be a crisis that's going to force us to cut, or inflation's going to get down to 2%. For inflation to get down to 2% to the point where the Fed would cut rates 4 times this year, there probably have to be a crisis causing that. Like that's not going to happen on an organic trajectory this year. I don't think.
Right.
Yeah. So yes. So and then of course all bets are off because who knows what the markets are going to do, and that it probably would jump initially no matter what's happening because hey, rate cuts, but then they'd probably say, oh, wait a minute, this is pretty bad.
Yeah, exactly. Well, and again, it depends on the context and all that. If they just start cutting rates and doing QE and nothing's really going wrong, the market's going to be at 7,000. So, again, I don't know which way it's going to go. And that's what I'm saying is like the one caveat to my entire statement is that the Fed really becomes aggressive about cuts and QE, and I have no idea where the market's going after that.
Got it. And I guess maybe just since we're just throwing spaghetti against the wall here, I mean, maybe some massive fiscal program as well could change the mix. Hey,
Absolutely.
checks for everybody, a month before the election.
Absolutely. If they can get how they would get that passed, I have no idea. But absolutely, that would be a game changer. You'd also have raging inflation, but other than that,
Right. Well, that's why I think if they were to do it, they do it close to the election, so you'd get the happy feel, but the pain wouldn't come until. But I agree. It's
exactly right.
Probably not going to happen. Be a difficult political road, but hey, we're just throwing spaghetti against the wall.
Exactly.
Okay. So let's see here. So last week you did mention that you had been to this conference. I think you gave us a couple of really interesting anecdotes to other topics we were talking about with the rich guys and then the bar across the street for the everyday man that was basically going out of business. Yep. But what were some of your key takeaways from the actual conference itself? Because it was focusing on distressed commercial real estate debt, right?
Yep. Well, there's been a lot of talk, about the next shoe to drop for the markets. I've seen a lot of commentary. I've seen a lot of articles and things about the commercial real estate crisis. It's going to be kind of the shoe that replicates the financial crisis. And what was interesting about this conference is that may not actually be the case. And I'm not saying that there's not a lot of stress and problems in the commercial real estate space, because there is. But, the one thing that caused, if we go back to talk about the financial crisis, the one problem with the subprime crisis was that we were starting to kind of work through some of the subprime issues until we shut down Lehman. And then that just caused all the counterparties to freeze and just everything went to zero literally overnight. What's happening right now is there's a very large appetite for distressed commercial real estate. And, this whole conference was investment bankers and hedge funds and a whole variety of other, type of investment bankers are all involved in this kind of commercial real estate. And banks right now, the big concern is the next shoe to fall for the banks. Banks are being proactive about getting these properties off their books. They realize there's a problem, and instead of waiting until something actually just breaks, they're getting these properties off their books. And these properties are coming off their books at 20, 30, 40 cents on the dollar. So I think I told you last week, there's a property in Sugar Land that, is a $173 million property that the bid on it right now, I think is 19 million. So they're just trying to get these properties off their books. They write them off, as their losses, and gets it off the bank's balance sheet. And these distressed debt equity guys are picking these up, and then they're going to hold them here for a while, let those property values recover. Maybe I'm seeing there was a lot of talk about converting commercial real estate into multifamily, because obviously there's a multifamily, there's a housing problem still. So multifamilies is kind of a key place. But conversion to multifamily, conversion to other types of uses, whether it's medical care, et cetera, because obviously we have an aging demographic, but a lot of very interesting comments. But I think the big takeaway is that this big shoe to fall in commercial real estate may not come, because it's getting taken care of very quietly behind the scenes.
Okay. So sorry, just help me understand who is eating the losses when these properties sell for the bank, but the banks have enough cushion to be able to absorb that?
Yeah. And they're not doing it. See, and this is the thing, right? How do you get a crash? Right. And so you have to kind of look at dynamics. and I've talked about this before with the U.S. just in general, is that, we have a debt problem, right? Nobody's going to argue that. We've got a Social Security Medicare problem. Nobody's going to argue that point. Well, that, right? You can fix that problem a little bit at a time, and it's not painful, right? We have to give up a little bit, right? It's a little bit of pain, to have maybe cut benefits or raise the retirement age in terms of Social Security. Or you can wait until the whole system blows up and then everything's done at once. And that's when it's really painful. Right. Same way with financial crisis. You have these subprime mortgages and they're all fine and dandy. And then we wake up one morning and you can't trade them with anybody. And then that's where the pain hits. So right now, if these banks are starting to alleviate these properties, one here, one there, one here, one there, they can do that it's like a controlled implosion, right? So, I can control the rate at which I liquidate these, and I can control the rate at which I write these down on my book. So I do 1 or 2 this quarter, I do 1 or 2 next quarter, whatever it is. I can control that impact versus if I wait and don't do anything, all of a sudden the FDIC steps in and says, yeah, you're done.
Right.
Yeah. And then you have
taking your bills in series versus they're all coming due all at once. Okay. Exactly. But I guess part of this is also dependent upon the market's ability or the private market's ability to buy these things from them. Right. And so
I am amazed at how much money is sitting out there. Private equity funds are sitting on over $1 trillion of dry powder right now. They've got so much money. Fortress Investment Group, BlackRock, basically, I talked to a couple of guys out there that are buying distressed debt. Basically, they put the deal together, they send it to Fortress, Fortress sends them a check. They have so much capital that they cannot put to work that they're just looking for deals to put it into.
So this is probably a much longer discussion than we have time for then, but sure. Interesting thought, which is, is this one of the probably many ill effects of growing wealth inequality, which we talk an awful lot about, right? Where you end up having these pools of, if this wealth was better distributed, households would be using that for constructive things that grow people's quality of life. Where when the capital amasses in a small group of people, they have trouble using it. It just piles up there, right? So it starts sloshing around and basically, potentially creating malinvestment because they're like, I got to do something with all these dollar bills that are piling up somewhere, right? So you have this, okay. So you have basically the masses that don't have enough, and then you have asset price distortion, maybe getting exacerbated as these pools of capital just pile up.
Right. But this is what we've been talking about for the last, 12 years, right? This is all a function of, Fed policy, more than a decade of zero interest rates, massive liquidity pushes. It's also a function of policy. I was having an interview yesterday talking about this very same thing about wealth inequality. And it's also a function of policy choices, right? And so take an example. We all want to save the climate, right? So we come up with this narrative that we have climate, we have a climate issue and we want to fix the climate. So we've got to come up with ways to reduce the amount of CO2 that is in the atmosphere, right? So that's the crisis that we need to fix because the CO2 is causing warming temperatures. So we've got to fix this problem. So how do we fix the problem? Well, there's a couple of ways we could fix the problem. So we know that planting a tree absorbs CO2. So we could all get together collectively and plant 1 billion trees. So we've got 330 million Americans. If we'd all go plant 3 trees, we'd have 1 billion trees. That would pretty much absorb your CO2 problem at just a natural cost, right? So we just plant a bunch of trees. Or we can pass a policy that says, oh, you have to drive an electric vehicle. So we're going to give you a subsidy to go buy an electric vehicle so you can drive electric vehicles. So what do we do with that policy? Well, we just took capital from the average Joe American and transferred it to Elon Musk, the battery makers, everybody else involved in the EV chain.
The lithium miners.
Lithium miners, et cetera. So in other words, you do a wealth transfer from the middle class to the wealthy and concentrate that wealth. Well, that wealth has to get invested And so generally what they do is they go to they go to, Fortress or BlackRock or some hedge fund manager and says, here's my capital, go invest it for me. And so that's how this malinvestment occurs. And at the same time, all we're doing is extracting more and more wealth from the middle class and shifting it up the pipeline. And that's how you create this wealth gap that we've seen over the last really 15 years that's just exploded.
All right, but yeah, and like I'm trying not to get wound up and jump more in this bandwagon because, as everybody knows, I can talk about it forever. But I want to
I'm just trying to use a simple example of how it works.
But
it's across all forms.
Right. Well, and how it's nefarious, at least from the average person's point of view, because they're basically, the wealth is getting transferred from them to parties that are already wealthy. But it also can create, it can distort true price discovery in markets.
Yep.
It can create additional instability. There's just a whole bunch of other knock-on effects from it. But okay, so where I want to take this is you took a little jab at me last week, and we didn't get a chance to really talk about it.
I was probably teasing you, by the way, but
oh, I'm sure you were. No, you were. But I want to just walk through my logic on this thing, which is I put this note out on Twitter saying, hey, looking at the profits and profit margins of corporate America, they're actually doing just fine post-pandemic. Whereas the average person has seen, a real hit to their own household profit margins because of the huge amount of cost of living that's gone up. Wages haven't really kept pace. Right. So let me just throw these charts up here for a second.
Wait. So real quick. I've slept since then. So remind me, what did I say to you? So I know what we're talking about.
Okay. Well, so I had said in there, which was a little bit of maybe a poor choice of wording, but I said, like, did we get price gouged? Like, basically, did the corporations just pass 100% of the costs that they would have needed to absorb onto the consumer, so they're not sharing in the pain with us? So let me just show these charts real quick. So this is a chart of corporate profit margins. I think this goes to the end of 2023, so it doesn't have 2024 in there, but you can see.
Yeah, I don't think we've actually put out 2024, first quarter of 2024 yet.
Okay, but you can see we're up near all-time highs in corporate profit margins. And then if you look on an absolute basis for corporate profits, we are basically at all-time highs. So, we've made it through the pain of the supply chain shutdowns, and, we closed the economy and all that stuff, and we reopened it all, right? And basically corporations are doing just fine, right? Where the average household is not, and is sort of permanently injured from this, right? So did the corporate side of the house basically just say, yeah, this pandemic sucks. Here, consumer, you take all the pain?
Well, the answer is yes. And I don't remember what I said to you last week. So if I say it again, just remind me what I said. If I sleep, I'm like David Spade in Blank, right? So just if I sleep, it's all over with. But yeah, but absolutely. But again, this is how capitalism works, right? And it's very interesting that when you start thinking about how we operate as human beings, we have a choice. We have the control over prices. We just have to be willing to sacrifice to bring those prices down. So in other words, if you and I have a business and we sell a widget, right? And everybody wants our widget, right? So we've got a TikTok account. So we've got our TikTok shop, and we go online to TikTok, and Adam says, hey, buy my widget. So everybody lines up to buy your widget. Well, if inflation goes up and prices go up, you go, well, people are still buying our, we got so much demand for our widget that we just can't get enough out the door. So we raise the price, and we keep raising that price until at some point somebody says, yeah, I don't really want that widget. And then when enough people say, I don't want the widget anymore, you and I, we've got to say, man, our sales are really down this quarter. We better cut our prices to see if we can start selling some product. And that's how you get deflationary pressures ultimately. And this is the juncture that Starbucks is now in, right? $5 for a cup of coffee, and it's not even that good of coffee. I mean, realistic, there's so much better coffee out there. But
By the way, I think $5 for a cup of Starbucks coffee is pretty cheap. I think you're getting a little Dixie cup at that. I think it's
well, I'm
more,
not sure what it is out in California, but I'm just
yeah, it's
saying,
like
you know,
7 plus.
yeah,
Yeah.
okay, so seven. Pick a number. I don't care. But anyway, I think Starbucks has temporarily found its limit of what they can charge for a cup of coffee, and competition's coming up. I don't know about where you live, but basically on every street corner around my house, there is a mom and pop coffee shop of some sort. There's Treehouse Coffee on, 2 streets over. There's a Black Rock Coffee. There's, just Black, it's just everywhere. And
By the
honestly,
way, I can guarantee you, you do not have as many coffee shops per capita as we have
I
out here on
I
the West
I am
Coast.
not arguing that point, but competition matters, right? And so if the more competition I have, then I don't have the ability to pass on as many costs. But again, as consumers, we've been doing great, right? Take a look at the retail sales numbers. We've been going into buy now, pay later programs and credit card debt and everything else to continue consuming. So yeah, corporations are passing on the price because we're still going out there to buy it. And until we stop buying that, everything that we want and more, prices are going to remain elevated. They're going to be able to pass that pricing power on. It's all about, as we talked about last week, it's all about supply and demand. And until that demand side drops, and prices aren't going to come down meaningfully on the products that we buy.
All right. I want to talk about one interesting story here, and it's this is related to the piece that you wrote on behavioral traits that go that often self-sabotage ourselves as investors. And I just want to talk about a way in which one of the reasons how the average investor sometimes can really kind of mess things up for themselves. And it's all stemmed in the fact that humans are really bad at assessing risk.
Yeah.
Right. Just there are some risks that we are wired for, right? Hey, is that tiger crouching and snarling? Okay, that means I should probably, fight it or run away, right? Like we're really good for that type of stuff. But things that are less immediately visible, that are more cerebral, that have uncertainty around them, we're really bad at assessing true risk here. And here's something that I do. I used to do when I would give live conferences to prove this. It's called the birthday problem. It's a famous problem in statistics. And what I'll do is I will, let's say it's a room of, I don't know, 150 people. And I'll say, okay, look, there's only 150 of us here in the room. There's 365 days in the year. I'm going to bet that 2 of you here in the room have the same birthday, not the same year, but the same, March 3rd or whatever, right?
Yep.
And who wants to bet me for it? And I don't know, hands usually, people think that there's some catch here. So I say, look, I'll pay you, why don't you bet me $1? If I'm right, if I'm wrong, I'll pay you $10, right? I win, I get your dollar, you win, you get $10 from me. Okay. And most of the people are like, all right, let's go through it. So we start having people in the room shout out their birthdays. And inevitably, somebody shouts out their birthday and someone else in the room says, that's mine too, right? So the person comes and, gives me their dollar. And I say, okay, look, who wants to bet me again? And I'm going to put another $10 down. So now if you win, you get $20. If I win, I get your dollar, right? And maybe there's 137 people left in the room at this point in time, right? So we keep going through. Sure enough, someone else has that same birthday. And I keep doubling down. Okay, I'm now going to give $30. And I keep going through with this until I've taken, fair number of dollars in the room, right? And the reason why I always win this bet is because, and I'm going to show you the math here, as long as there are 50 people, sorry, as long as there are 23 people in the room, I have a 50% chance of winning that bet. If there's 50 people in the room, I've got like a 95% chance of winning that bet.
Yep.
And it just sounds really counterintuitive. Wait a minute, there's 365 days in the year. You've only got 50 people in the room, but there's like a 97% chance that they've got 2 of the same birthday. It's true. It's the math, right? But again, our brains just don't think this way. And so I want to combine that with, to be an investor, you have to really enter in with humility, right? That like, look, the thing that I'm so passionate about that I think is definitely going to happen tomorrow, and that's why I'm making this trade, right? you got to be humble and just say, look, we're not great risk assessors to begin with, and there's probably a whole bunch of other risks that I'm discounting here that I'm not even thinking about, right? So you got to walk in there with that humility that if it's a strong conviction that you're feeling emotionally that's driving that decision, you're probably overemphasizing the risk of it happening and probably underemphasizing the risks that can get in the way. I want to combine that with another theory, and it's called the theory of loss aversion. And I'm going to see if I can pull up a chart for that as well. But basically, this is a theory. It's been, I mean, the research has been tested. It's been put forth by Daniel Kahneman, who's also another very famous behavioral economist. And it basically says that we as humans, human animals, we experience the pain of a loss twice as much as we experience the joy of a gain. So when we're investing, what tends to happen, and this is referred to as prospect theory, is we start giving an outsized importance to the money we think we could make. But if we, and so that generally drives us to maybe stretch further and more aggressively than we should. And we forget that, hey, if this goes against us, I'm actually going to hate that loss twice as much than if I'm right and make a gain off of this thing, right? And we learn this lesson the second the trade goes against us.
Yeah.
Right.
Well, no, I said this a couple of weeks ago. You know, we've had this outsized rally since November, right? We're up 20% at the peak of the rally back in March, and we talked about this. You know, back in February and March, you and I were discussing, hey, you know, we're going to have this correction at some point. It's just a function of time until we get there, and it's going to be 5 to 10%. And it's going to feel a lot worse than it actually is. And sure enough, we had a 5% correction, and you wouldn't believe all the emails I was getting. It's like, man, is this correction ever? Is this the start of the bear market? I saw articles like, you know, the bear market returns, and it was a 5% correction. You're up 20%, you get back 5, right? But that's to your point that psychologically those drawdowns hurt a whole lot more than the gains we make.
Yep, and here's just the chart for those that are watching on the video of the actual pain curve that they've the emotional pain curve that they've mapped out through research here, and so it's important because this really tells us, look, we're bad at assessing risk, and when we're wrong, we feel it a lot more than when we're right. So one of this is it's a real argument for risk management, right? It's like, don't take unnecessary risks. You know, if you find that you're getting caught up in feelings of FOMO, or you're just super excited or super confident something's going to happen, you got to keep all this in mind. At the same time, you got to also note that, okay, because I feel a loss twice as much as a gain emotionally, I got to be careful of making decisions when like my portfolio is turned against me, because I'm going to be making decisions from this really primal standpoint, right? Where I'm probably going to be making very bad decisions. And this is, Lance's, you know, what you say is okay, people get shaken out of the markets right at the wrong time. Then the market takes off, and then they can't find themselves getting back into the market because they feel like, oh my gosh, I'm going to be the greatest fool now if I jump in now, right? So it's very important to have all of this, I think, behavioral science in mind when you're becoming an investor. And I'm going to tell one last anecdote here and let you react to, which is, you know, a lot of people, you say, you know, be careful about listening to headlines. At the same time, too, you know, I would say be careful about listening to our authorities. You know, we just talked about how Powell came out this week and, you know, said an awful lot of stuff. You know, when you get to consider the source, we've talked about this in the past, which is there are things that Powell's just never going to say, right?
Right. There's things you can't say.
Yeah, things you can't say, right? And a lot of times the average person would say, well, look, if it was that serious, you know, they'd be telling us, right? In a lot of cases, no, they're definitely they're specifically not going to tell you, right? The old Paul Juncker, when it gets serious, you have to lie to the masses, right? But also too, like these guys are wrong a lot of the times, right? We attribute godlike powers to them, but I mean, Lance, I mean, if you look at the Fed's, what's the Fed's track record on its predictions?
176 to 0.
Yeah, I mean, they're just terrible, right?
Yeah.
So when I was a kid, my first job was I had an odd jobs business. And I think I was like 14. And there was a successful lawyer who lived in town, and he had a house on the bank of the Connecticut River, his big house. He was building it at the time, and I was doing a lot of odd jobs for that. But he called me up one day and said, "Hey, come on over. I need your help." And on the riverbank in front of his house, there's a little beach, and there'd been a storm, and a bunch of dead wood had just washed up on the beach, and it was all in this big tangled pile. And he decided that he wanted to burn it. So he, helps me get him a couple jerry cans of gasoline. We bring it down there. He's throwing it over this pile. He climbs up to the top of the pile, and then I see him reach in his pocket, and he pulls out a matchbook. And I'm 14, and I'm thinking, this doesn't seem very smart, but this guy's a really successful lawyer. He's an adult, clearly must know what he's doing. The guy lights the match and disappears in this ball of fire, all the gas fumes. And he jumps off the pile and dives into the water, and then swims to shore, and I help pull him out, and I'm asking him, like, "Are you okay?" And clearly he was, shaken by it. And he's like, "No, I think I'm okay." And I realize his hair is still kind of smoldering at the top of his head. So, I'm like, "Wow, that was amazing. I hope you're okay." And he was like, "Yeah, maybe that wasn't the smartest thing to do." And as we're talking, his face starts turning pink, and then it starts turning red, and then it's just like crimson, right? And I'm like, "I think you need to go to the hospital." And he's like, "Yeah, I think I might need to too." So he ends up going off, and he has second-degree burns or whatever, right? But the point is that, I just assumed this guy knew what he was doing.
Yeah.
Right. And I think we need to be really careful at times of just taking, the monetary authorities at their face value, because they oftentimes don't know what we're doing. And we as humans are just bad at assessing risk.
Yeah. I think you go one step further. I think you should take everybody with a grain of salt. Everybody. I mean, literally anybody, because we're all just guessing. I'm guessing at what the markets are going to do. I know, look, all I do all day long is just analyze data. That's all I do. And I analyze all this data, and I try to make the best assessment that I can about what things are going to happen in the markets over the next week, the next month. And outside of that, it's completely useless. But, over the next couple of weeks to a month, you can kind of make some reasonable assumptions. But outside of that, anybody talking about stuff that's going to happen a year from now or 10 years from now, they have no idea. And basing your portfolio on that type of an outlook is just foolhardy at best, because again, there's so many things are going to change. The world's going to change. Economics are going to change. Monetary policy is going to change. Fiscal policy is going to change. And all those things are going to affect the outcome. We just don't have any idea what's going to happen in the future. And, if we did, if I could foretell what the future was, you and I'd be sitting on a beach somewhere, living it up, because we would have it all mapped out. But it's just not the way it works. And so it's really important to, take measured steps with everything you do, and understand that with everything you do, there's a likelihood of you being wrong. And if you're wrong, what's the penalty going to be? I'll give you a good example of this. So back in March, early March, you and I were talking about this correction of 5 to 10%. And so we run a portfolio for high net worth investors that uses option strategies and other stuff in it. And so we made a call to go out and write a naked call on the S&P 500 at 5,300. And the problem with that is that if the market rallies above 5,300, I've got to buy the S&P index at 5,300, right? Yep. And then turn it over to the option guy. So we took a risk because we were betting on this correction. We said, okay, we think we're going to get a correction, and the option matures on May the 17th. And we said, look, we're gonna do this trade, and we got paid very nice for it. We got $4 a contract on this. We got a very nice inflow of capital from that. So, but the risk was, so how do we measure the risk, right? So if I'm wrong and this market goes to 5,301, I've now got to buy this option. So, I've got to redeem this option and buy the S&P index and then give it to Adam. Let's say Adam was the guy on the other side of this contract. So I've got to give that money to Adam. So at the same time, so we look at the portfolio and we say, well, if the market goes up that much, our whole portfolio is going to be up 1.5% in that environment. and I'm making up numbers, but the whole portfolio will be at 1.5%. This position is going to subtract 20 basis points. If the worst outcome occurs, I'm going to lose 20 basis points of portfolio. So that's how we decide. We say, okay, that's a reasonable risk. I can take that risk for $4 a contract. I can take that risk. Mm-hmm. So that's how you measure the risk. Now, if we'd done that calculation, it's like it's going to take 5% away from the portfolio, we'd have never done it, right?
Right.
Fortunately, the market corrected, and we bought that contract back at like 50 cents a share, so it worked out really well. But that's, you've got to measure everything for risk. So the point is that if you've got a position in your portfolio, I'll give you another good example real quick of what's going on right now. Let me share a screen with you. I just posted this out on Twitter this morning. Hold on one second. Right here. So this is cocoa futures. Cocoa futures are down about 50% over the course of just the last few trading sessions. And same thing, by the way, not just cocoa futures, but coffee futures as well. Huge decline in this. Now, those things were going skyrocketing straight up, and everybody was getting on this whole trade. It's like, oh my gosh, coffee's going to the moon, cocoa's going to the moon, better be in this commodity trade. And that's fine. And the problem with all commodities, whether it's oil or metals or hard grains, soft commodities, etc., they're all just traded. These are all commodities traders up in New York on the NYMEX trading these commodities. There's no fundamentals behind these. It's all just speculative trading based on weather events and supply versus demand and all this type of stuff. Well, these things can get really exacerbated from time to time because of speculative exuberance, right? So once that trade starts moving, all the traders pile into that. Well, these are professional commodity traders. And like I noticed in my thing is in my comment is that they will skin you alive at the end of the day. They know who's on the other side of these contracts, and they know the retail investors are going to be the last guys out. So when they run these things up, they sell out at the top and they take their money home and go home for the day. You're hung up holding ththese things and lose 50, 60, 70% of your money before you realize it's time to get out of it. So this is all about measuring risk. And one of the comments I got last on that article I wrote, this guy says, he goes, I have a simple rule. He says, when I am over the moon excited about the market, I sell. When I want to throw up, I start buying. And that's really just a great way to look at anything. When things are doing great, take profits. When things are doing terrible and you just don't want to buy anything, that's when you want to buy stuff.
Yeah, well, it's the famous Buffett, be fearful when others are greedy, and opposite around. Okay, well, look, I think we're making a really good case for risk management, for probability assessment. Again, for most people, important thing is just to be aware that we're not naturally good at it. So recruit a professional that can help you keep that stuff in check and put together a plan for you that as long as you are committed and disciplined, it's bleeding away the risk that you're going to be, letting your lesser angels, work against you here, and you're just going to let the math of compounding and diversification and all that stuff that we talk about work for you in the long run. All right. Yeah. So as we wrap up here, Lance, you got to apply this to something. You got to apply this to some investment decisions. So what trades have you guys made this week?
So we've done let me take a quick gander here, just a second.
It sounds like you've been busy.
Not too busy. We did a few things this week. It was really mostly repositioning and kind of looking at, kind of where we want the portfolio to be here over the course of the next kind of few weeks. But so let's see, what is today? May the 3rd, April the 26th was last week. Okay. Mm-hmm. So the only trades we made this week were today, actually. And so we added to Stanley Black & Decker. Again, they had an earnings report yesterday. It was actually pretty good. Management commentary was very good, as I said earlier. And so we, in the equity model, we just added to that position, brought it up to a 3.5% weight in the portfolio. In the dividend equity model, we had previously bought Meta before that huge run up, and we've been kind of using this pullback in Meta to build out that position. So in the dividend equity model, you go, well, Meta doesn't really pay a dividend. It's true, it doesn't. This
I
is a
was
little
just
bit.
going to ask that.
Yeah. So the way we constructed this model, and I'll kind of show you the layout, for the model itself, is we want, what everybody wants. Everybody wants the world, right? So what I want is I want a portfolio that'll give me a nice dividend yield, but also will track the market, right? And so in order to track the market, you better own those top 10 stocks. Well, the top 10 stocks really don't pay much of a dividend. So what we did is we broke the portfolio down in two fashions. So the top 5 stocks in the portfolio comprise about 30% of the portfolio itself. So 30% of the portfolio is effectively Apple, Microsoft, Google, Meta, et cetera, and Amazon. So they comprise a big chunk of the about 30% of the portfolio, which, by the way, if you look at an ETF, that's about what they comprise an ETF. So if money flows into the market, they're going to capture 30% of that increase. The other 70% of the portfolio, now we're not completely built out. We just launched this portfolio about mid-January, and so we've been using dips in the market to try to buy our positions in. So we're still running, even as of today, we're still got about 27% cash. The portfolio is up 3.71% since we launched this thing kind of mid-January. So it's kind of tracking its index and market right now for its weight. If it was fully weighted, it'd be basically about where the market is. So in that, we're then working through adding the other positions that we want to own that are all dividend yielding stocks. And so the portfolio will yield right at about 3.5% to 4% in terms of a dividend yield, and should give us fairly close performance to the S&P 500. So again, it's going to be a little bit more volatile than, say, our equity portfolio that has, our 60/40 equity portfolio has bonds in it. That's going to slow down the volatility. But this will give you a little bit more dividend yield with a closer tracking to the S&P 500 in theory. And so we're running this one right now. But so we added to Meta, which is brought that position up in the portfolio. We also added to one other position. I forgot what it was. Hold on.
AEP.
Oh, AEP. So we sold out. Thanks for reminding me. So we sold CVS because it just kind of crapped the bed.
You got your point where you're like, I'm out. Okay.
I'm out. I'm done. In fact, I even wrote that. I said, I'm done with it. But in the portfolio, we're adding AEP, and we've got a little bit of an overweight in utilities, not because of the dividend yield, but we own AEP now. We just bought that one. We own Duke and Con Ed. And the reason that we own those 3 utilities is that gives us diversification across the United States in basically electricity utility providers, because the one big aspect that AI needs is they need power. They have to have electricity. And the more AI that we do, the more energy consumption it's going to be. So we now kind of strategically located our utilities between the East Coast, Southwest, mid-region of the United States, and a little bit on the West Coast, but primarily a big chunk of the AI data centers are in the Midwest because of taxes and regulations, those type of things. So you had a big chunk of data centers in kind of the Midwest and down into Florida, and then another chunk up kind of in the Northeast. So we've kind of strategically located our power providers in those areas.
Isn't that funny how the AI enthusiasm is now bleeding over and making the sleepy utility sector an exciting part of the AI,
Well, and as rates come down, they're very interest rate sensitive. So when rates come down, they should really start to pay off.
They should do well. Yeah.
And by the way, a lot of these like AEP in particular, they are now triggering a monthly buy signal, which has typically been a really good entry point for utility stocks. But we're getting that across multiple utility stocks right now.
Okay. All right. Well, thanks again, as you do every week, for being so transparent with your trades. And speaking of trade transparency, you were using the SimpleVisor platform there to show us that data.
Yep.
I think we mentioned last week that you're close to sort of fully launching that, and we want you to do a real deep dive for folks here. Yep. on one of these weekly market recaps in the future, maybe even next week, depending upon where you guys are with the product. But I just want to.
Yeah, I was just going to say, yeah, so the new platform is up. The only thing I'm really kind of waiting for is that, we're going to have about 10 different equity models of different types that you can subscribe to and basically open an account at Fidelity and, trade your own portfolio. And these will be kind of programmatic driven portfolios for you. We're very close to having the linkage between the website and Fidelity set up, so you can do your own account opening process, select your model. It'll automatically allocate into the model. But we're going to have an AI model. We'll have a dividend growth model, of course, like we just showed you. You'll have various forms of the 60-40, 80-20, 70-30 conservative models. You'll have an all-weather model. I'm even going to create an Adam Taggart thoughtful money model, so he can give me his best ideas from his guest, and we'll apply those to that model. So you have a whole bunch of models that you can choose from, but I'm very close. We're just we hung up a little snag in the account opening process with Fidelity. So our programmers are working on it. So hopefully in the next week or two, we'll have all that up. And then shortly after that, we'll introduce financial planning as well.
Okay, good. Awesome. So when I mentioned this, I think last week, I got a ton of comments saying, "Hey, yeah, do the SimpleVisor primer." I think you just got those folks even more interested now. So we'll do it as soon as you can. And again, I just want to make folks be super clear on this, which is this is the process I think most people who watch this video should go through, which is first question you need to ask yourself is am I going to be my own financial quarterback, or do I want to try to recruit an all-star one and have them, come up with my plays and my strategy and execute it for me? There's no wrong answer there, except whichever one isn't the best fit for you. But if you decide that you want to be your own quarterback and be a DIY investor, that's great. SimpleVisor is a great solution for that because it basically lets you look over the shoulder of Lance and his team. And as he said, you get all the information and data that comes along with that platform, and Lance will walk you through all the bells and whistles of all that stuff. But you can see the different portfolios that they put together and the trades they're making as they make them. So if you want to pull elements of that or copycat that or whatever on your own, you can. That's for the DIY investor. Now, obviously, if you want to recruit a quarterback for your team, these are the advisors I have in the program that I think, hey, at least talk to these guys, because you get a sense for how they think and what a good advisor, will look like. And then you can use them as a standard, for interviewing other advisors as well. And whomever you end up choosing to work with, I want you to pick whoever you feel is the right one for you. Now, if you have if you're just starting out and you're below, $150,000, Lance and I have talked a lot in this program about there's a lot of things that you should probably do first, like, pay off your debts, maximize your retirement accounts and all that stuff, and then just focus on a simple strategy of basically putting as much, building that investing muscle by getting from zero to hopefully up to about 100 or 150,000 in an account. And then you're at the point where you can kind of graduate and then either decide if you want to be a DIY investor or work with a financial advisor. So if you're in that camp, the SimpleVisor Solutions is really helpful for you because it basically just gives you something to plug into so that as you're working on developing that investing muscle, you're kind of following the best advice that advisors like Lance, have given us in terms of like what the guy just starting out should be. And then hopefully when you get up to the high enough level, then they can step in and say, look, these are all the additional things we can do for you now that you've got enough assets. So I think the SimpleVisor platform is really useful for this standpoint because it kind of addresses two of these potential routes for people.
Yeah. And to your point, I'm actually going to build a portfolio. One of the models that'll be available on the site will be that starter portfolio. So it'll be just here's the model. Just open your account, start dollar cost averaging into it every month, every paycheck, whatever it is, and we'll adjust it over time depending on what markets are doing. But it's going to be more of that buy and hold type structure, but it'll be there for you so that you can just model right into it, track it, keep up to date on the performance, how it's doing, et cetera.
All right. Well, as usual, Lance, we've run longer than expected, so I got to wrap it up here. Folks, whether you're crepuscular, whether you're matutinal, whether you're diurnal, whatever, but if when you are active, the first thing you reach for is the weekly market recap to get your weekly dose of Lance, please let them know by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. We've talked an awful lot this time about all the reasons why the vast majority of regular investors should work under the guidance of a good professional financial advisor. So if you haven't yet talked to one of the ones that are endorsed by Thoughtful Money, but feel you could benefit from it, just go to thoughtfulmoney.com, fill out the short form there to get one of these consultations. As a reminder, these have become quite popular, and the advisors are very busy. So, reach out only if you're really ready to take action in your life here. If you're serious about it, these guys will definitely drop what they're doing and talk to you. But otherwise, if you're kind of just kicking tires right now, these guys are so overwhelmed with talking to prospective and existing clients. It's better for them and it's better for you if you wait until you're at a point where you really need to make some decisions, or you're just really energized to get started. All right. With that said, Lance, I'll let you have the last word.
No, that's great. Yeah, I mean, we'd love to talk to you and love to help. And so again, click the link, send in the form. We'll definitely have somebody get back in touch with you right away.
All right, buddy. Thanks so much for hanging with me for yet another week. Everybody else, thanks so much for watching.